Hello, everybody. How have you been? I hope you're doing well. I welcome you all in today's topic, which will complete our first chapter of Indian economy. We have a last portion left. All the above topics are already discussed in the previous videos. Kindly check them there. Also, watch the video until the end to grab the concepts that are used regularly in the field of economics. Let's get started and look into the first topic. See, national income is required to measure the progress of a country. And how do we measure them? We have different ways to measure them. All of this is mentioned in this book itself. We look at the brief and the objective overview of all these topics. Let's first know about GDP. See, the concept of GDP was put forward by the US economist Simon Kuznets in 1934. And this method calculates a country's income at domestic and the national levels. So let's know about GDP. What is it? It is the value of all final goods and services. Final is different, goods and services is different. Produced within the boundary of a nation during 1 year period that we have, and in India this calendar year is from 1st April to 31st March. So let's first know what do we mean by this value, the final and the goods and services that's mentioned here. Everything is mentioned in this video and every little concept is there in the book. We do not have to worry. Let's first quickly look into all of these words and see what do they mean. See, when we see it as a value of all final goods and services, we see how is GDP calculated in other way. See, calculated GDP we see is done by adding the national private consumption that every individual has, the gross investment that's done in the country, the government spending that government regulates, and the trade balance, that is the exports minus imports. Now, why do we have here the exports minus imports? Because it removes expenditures on imports that is not produced in the nation, and it adds expenditures of the goods and services produced which are exported, however not sold within the country. So let's look into the concepts that we were talking here. See, when we talk about gross, it completely you can equate it with the total means in mathematics. The total word that's there, you can equate it with the gross word in economics. Next we have domestic. Domestic means that the activities that are done is within the boundary of a nation and also by its own capital. Then when we see the product, this is used to define the goods and services together that we had here. And when we see final, it means the stage of a product after which there is no chance of value addition in it. So it's like when you've added all the values of all the goods and services that's there, we come to the GDP of our country. And when we mention final, we see that after the GDP is calculated, there has not been a single stage of a product that has been missed out. And GDP is used in different ways. Also, when we see, for an example, that if a country has a GDP of rupees 107, which is 7 rupees higher than the last year, we say that it has a growth of 7%. Also, when we use the term that the economy is a growing economy, it means that the economy is adding up its income. However, GDP is only for its quantitative concept. It only indicates the internal strength of the economy. Why? Because we have seen here the trade balance, we have excluded the imports, and we have also added up the expenditures of the goods and services produced which are exported. So we only see the internal strength. Also, it does not tell us about the qualitative aspects of the goods. It's only about the quantitative that we see. We also have one more thing. GDP is the most commonly used data, and the GDPs of the member nations of the IMF are ranked by the IMF at purchasing power parity, that is the purchasing power capacity that every individual has in a country. Next we come to NDP. Let's quickly look into it. NDP is what? The net domestic product. How can we find that? We see GDP, we've calculated GDP, and we subtract depreciation. We adjust the weight of the value of depreciation, which gives us a net form of the GDP. So it is the net domestic product. So it's basic that GDP minus the total value of the wear and tear, the depreciation that has happened in the assets. Why? When the goods and services were being produced. Also, the governments decide and announce the rates by which the assets have to depreciate. This is one way how depreciation is used in economics. That is the wear and tear that has happened in the assets. I think this is the same concept that's used in accounts. Next that we have is that in the external sector, when the domestic currency floats freely as against the foreign currency, and if this value of our domestic currency falls, the following the market mechanism in comparison to a foreign currency, say dollar here, it is a situation of depreciation in the domestic currency. This is another way of calculating depreciation in economics. Thus, NDP is GDP minus depreciation. Next, C. NDP of an economy always is lower than its GDP. Why? Because when we have calculated GDP, we'll have to subtract the depreciation, and once we do this, this will always be lesser. It will always be lesser as compared to the GDP. Now, we saw the different uses of GDP. We'll see the different uses of NDP. See, NDP is used for domestic use to understand and analyze the sectoral situation of depreciation in industry and trade. Also, it is used to show the achievements of the economy when we see the research and development area where we have tried cutting the levels of depreciation in a historical time period. So, it shows us the achievements that we've had. Also, NDP is not used in comparative economics. That is, when we compare the economies of the world, which we saw here that IMF ranks the GDP, and thus it is used in comparative economics, but NDP is not used. Why? Because the rates of depreciation are different and are set by the different economies of the world, as we saw here that the governments decide and announce the rates by which the assets depreciate, and in India it is done by the Ministry of Commerce and Industry. So this was it. However, depreciation and its rates are also used by modern governments as a tool of economic policy making. This is the third way of how depreciation is used in economics. We saw GDP, we saw NDP, now we'll see gross national product and what is its use. See, gross national product is the GDP of a country where we've added the income from abroad. See, here in GDP we had excluded all the exports and the imports which were not considered, which were not related to our country. See, when we saw here that all the expenditures and goods and services produced which are exported but not sold within the country, we had excluded all of them. But here in GNP, the GDP of a country is added with its income from abroad. So items that are included in income from abroad, let's quickly go through them. This is the private remittances, that is the net outcome of the money which inflows, that is any person working outside who has sent his salary, which has been dollar or any other foreign value that has been there in that country, and in India it came into its INR, and outflows on account of the private transfers that has been done, which we come to know it as private remittances, which is one part of income from abroad. The second part is the interest on external loans, that is the money lent out by the economy and the money borrowed by the economy. The interest, the net outcome of all those is considered into the income from abroad. In case of our country, we have remained a net borrower from the world economies. The third point that we have is external grants, that is we balance the grants which flow to and from India. What are grants? These are basically investments or donations that we do to other country in their time of need, or the other country does to us in our time of need. So the grant outflows from India has increased as its economic diplomacy aims at playing the bigger role at international level. However, since we have remained the net borrower, we will see that India's GNP is always lower than its GDP. Why? Because since we have remained a net borrower, our income from abroad, which includes private remittances, interest on external loans and external grants, has always remained negative. So when we see the formula, it is GNP is GDP plus income from abroad. But since India has negative income from abroad, it is GNP is GDP plus the negative amount that we get. So it's basically GDP minus income from abroad in our country. And that is why India's GNP is always lower than its GDP, like NDP. However, NDP is lower in all the countries, but GNP is only lower in our case. Different uses. See, we saw that GDP measures the quantitative concept. It excludes the qualitative aspect. However, we'll see that GNP sees the quantitative as well as the qualitative aspects, that is the internal as well as the external strength, because we have income from abroad here. It also helps us learn that how much the outside world is dependent on its product and how much it depends on the world for the same. Also, what is the standard of its human resource? Because we have private remittances here. So if the human resource of a country is high, that human resource would go out and work for others. And if the human resource of a country is low, those people cannot work outside because no outside agency would hire them. So it gives us the standard of human resource and what position it holds regarding the financial support from and to the world economies. This is it with GNP. Now let's look into NNP. See, when we saw NDP, it was GDP minus depreciation. So when we see NNP, it is what? It is GNP minus depreciation. GNP after deducting the loss due to depreciation. Also, when we connect it with GDP, it is what? It is, we break this GNP, it was GDP plus income from abroad, and in case of India, it was GDP minus income from abroad, and here we deduct the depreciation. Let's quickly look through their uses also. This is the actual national income of an economy. Also, this is the purest form of the income. Why? Because when we see this net national product and when we divide this value by the total population, we get the per capita income of that nation. However, we need to see that this can differ because the rates of depreciation followed by different nations make a difference to the per capita income. Why? Because this depreciation value is different for different people, different country, and depreciation affects the value of NNP of a country. So these were the four factors of national income that we were talking of. We have done GDP, we have done NDP, we have done GNP, and we have done NNP. Let's quickly go through them. This was GDP, the value of all final goods and services produced within the boundary of a nation. We had NDP, it was GDP minus the depreciation. We had GNP, it was GDP of a country plus income from abroad, and in case of India, it is GDP of a country minus income from abroad. And then we had NNP, it was GNP minus depreciation, also GDP plus income from abroad minus depreciation. Next, we look into the cost and price of national income. How do we determine the cost of the national income and the price of the country of how it is calculated regarding the demand, supply, the production, the products, the goods, and the services? Let's quickly go through them. It's a very easy concept. See, the issues related to the cost and price always comes when it's the time to calculate the national income. So there are two sets of costs and prices that an economy needs to choose, at which two costs and two prices it will calculate its national income. So what is its relevance? See, cost. See, when we see that there are two sets of costs and we see there are two sets of prices. See, we had two sets of costs, that is factor cost and the market cost. So what is factor cost? It is the input cost. What is input cost? See, when the producer produces a commodity, produces a good, he has to incur in the process of producing. What can be all those the costs that are incurred here? They can be the cost of capital, that is interest on loans, raw materials, the cost of labor, hiring labor, the rent paid, or the power of electricity that's consumed, and everything and anything that's incurred in the process of producing something are the input cost or the factor cost. It's also called the factory price or production or cost price. So this is nothing but price of the commodity from the producer's side, which he has seen when he had to incur in the process of producing something. And market cost is derived after adding the indirect taxes to the factor cost of the product. That is the actual price that we see in the retail showrooms, which is there. And when we see price, we can see that income can be derived at two prices, the constant price and the current price. What is the difference? The only difference is the impact of inflation. How? When we see the constant price, we see that one base year is selected and inflation is considered on that base year, and then constant price is calculated. But when we see current price, it is a present day inflation which is added. So basically current price is the maximum retail price that we see printed on the goods selling in the market. This was cost and price of national income. Next we come to the revised method that has been happening since all these years, and we'll see the new and revised data of the national accounts that has affected two changes and the major changes which were incorporated in these revisions. The first thing that we need to know is all these releasement of all the new and revised data is done by the Central Statistics Office CSO, in which this thing that we are going to study is in January 2005 it was released by the Central Statistics Office. So the base year that we saw here, which was required to calculate the constant price, was revised from 2004 to 5 to 2011 and 12, and this was done how? It was done in accordance with the recommendation of the National Statistical Commission. So what are the major changes that we've seen? The growth rate that was there, which was measured, which now would be measured at GDP at constant market prices. GDP at constant market prices, and the base year was changed from 2004-5 to 2011-12. Also, which was in earlier form was at GDP at factor cost and at constant prices. And factor cost we've seen, the market prices we've seen. The factor cost was here the price of the commodity from producer side, and the market price, which now we'll see, is the retail price that's there in the showrooms that we get. Next that we have is the estimate. The sector-wise estimates of GVA will now be given at basic prices instead of factor cost. Let's quickly go through what do we mean by gross value added. See, again I'll insist there is nothing apart from this book. Everything is there in the book. Let's quickly go through what do we mean by GVA. See, GVA is the difference in value between the final good and the cost of ingredients that is used in production. So what do we see? The difference in the value between the final good. When we saw here the market cost, that is the price that the cost at which the goods reach the market, this was a final good price, and the cost of ingredient used in the production. This is what we mean by GVA. Let's see this with an example. See, if we have a pen that when produced costed us 2 rupees when produced, but when it reached the market, it costs in the showroom is 10 rupees. So the 8 rupees that was here, the difference in the value between the 10 rupee and the 2 rupee, that is the 8 rupee, is our GVA. So what is it? It is the total cost of factors. It is the total cost of factors that are used to produce in a good or a service. The total cost that is used to produce a good or a service that we can see here. So what is it basically? It is, maybe you can have the compensations that you have to give to the employees, or the surplus or the mixed income that you're thinking of to generate when you are indulging into the activity of producing. Then we have the CFC. What do we mean by CFC? CFC is a depreciation that you see, you count, so that your assets that have been depreciating, that has been affecting your profits, you count them. And then we also see the production taxes less production subsidies. What are the production taxes? They are the amount paid or received during production. Anything that you have to pay or receive during production, maybe the land revenue or the registration fees that you might have incurred when you were to produce this, and the tax on profession that you've given, these are all the production taxes. That is the amount paid or received during production. This does not incur with the amount of the quantity of how much you are producing. When you are asked to pay the land revenue, you will not be asked, if you're producing 100 pence, you pay this much amount. If you're producing 5 pence, you pay this much amount. It depends on the land that you are renting, or maybe you are leasing, and accordingly you will pay the revenue. So these are the production taxes, and less the production subsidies. Maybe if you want to produce an essential food item, or the input subsidies that's given to farmers, or maybe you indulge into manufacturing or producing or trading of say fertilizers or say pesticides. So what do? You get subsidies from the government. Those subsidies, the input subsidies, farmers, villages, to small industries, to administrative subsidies to corporations or cooperatives, all these production subsidies would be reduced from the production taxes, and the value would be added to the GVA at basic prices. This gives us the gross value added at basic prices. And what is gross value added? It is the total cost of factors that are used to produce a good or a service. And what is the difference between GVA at basic price and GVA at factor cost? When we have calculated GVA at basic price, we will deduct the production of taxes and add production subsidies, which in this case we were deducting subsidies and adding taxes. This is the sole difference. And if we want to calculate GDP, how can we do that? We can see that when we have GVA at basic prices, we add the product taxes. This was the production taxes. Now we add the product taxes, and then we deduct the product subsidies. Let's quickly go through what are product taxes and product subsidies. See, when we see product taxes, these are the excise tax, sales tax, service tax, import and export duties, of which all of these have been substituted with GST now. And when we have product subsidies, it might include, subsidies that you get when you want to produce some essential commodity, maybe food or anything that you get from government to initiate or to promote the manufacturing or production of that good or service. So the product taxes and the product subsidies, you put the value here and you add and subtract the GVA at basic prices respectively, and then you get the value of GDP. So next we can come to the difference between GVA and GDP, which can be very, very simply known. GDP is what? GDP is equal to GVA. However, added with the net taxes. That is the adding of product taxes minus the product subsidies. So what is GDP? It is equal to GVA added with the net taxes. Also, let's quickly go through the economic growth. This part is just the explanation in words that we've seen, the explanation of this formula, this paragraph. See, economic growth is estimated using two sides, demand side and supply side. What is supply side? It is the value added by the various sectors in the economy, and this are all added up to derive the gross value added. It captures the income generated by economic actors across the country, the agriculture sector, the industry actors, the services actors. So all of these are added to give us the GVA. However, under the demand side, we have GDP derived by adding up all the expenditures done in the economy. Maybe your private consumption that you do, maybe expenditures by government or business enterprises, and the net exports that we have. So it includes all the taxes received and all subsidies dispersed by the government after this calculation that we've taken out. This gives us GDP, and this gives us GVA. And when we add the taxes received and disburse the subsidies, we get the net taxes, and this, when added with GVA, we get GDP. Also, there is one more difference or use you can say. See, GDP is a good measure in comparative studies, but GVA is a better measure to compare the different sectors within the economy. So this can be an external thing, maybe different among the economies that you can do, but the different sectors within the economy, maybe agriculture sector or industrial sector or service sector, which is producing better or less, we can know through GVA. Then we also have fixed base method and chain base method. See, government is at present exploring the idea of shifting to the chain base method. And how can they do that? See, in this method, the GDP estimates are compared with the previous years instead of fixing a base year, which we saw in the constant price method, which is revised every 5 years. So this base year, instead of having this, which was there in fixed base, we have chain base that gives us the previous year base as to calculate the GDP. So in a fixed base, we had weights assigned that stay unchanged even if the economy changes structurally. So that was a problem to us, but this method does not factor in relative changes in prices and impact on demand. And in chain base, weights assigned changes annually, and it captures the structural changes more quickly. And the current gig economy that India is proceeding to, it would be better for us to switch to this. Also, advantages of chain base we can see again here. It will capture the structural changes. It will compare the India's growth data sets with other countries, and this comparing would get easier and better as this is the best international practice today. Also, it is believed to prevent the ongoing controversies related to data sets. This is it with our fixed base and chain base method. See, this topic that is here, you can go through this portion because I tend to skip the current affairs due to the lack of updated edition that every book keeps giving us. So this is it for this video. I'll come up with the next video soon. Stay home, stay blessed. Thanks for watching.